Well, welcome, everybody. My name is Michael Columbus. I'm with Family Wealth and Legacy in Rochester, New York, and we are going to be bringing you another market update. Actually, it's been a few months since we put one together, and wanted to give you, some heads up in terms of what's happening out there today. So let's dive right in here. 2023 has been a little bit of a wild ride. Many of the most successful investors in the last decade or more we're calling early for a recession and thinking that the Fed may actually kind of break the economy or bust the economy. Here we are in October, and the S&P 500 closed at 4,117 points, up 7.25% for year to date. However, keep in mind that as of July 31st, the S&P 500 was up almost 20% at 19.5%. So the first half of 2023 did not look like I had anticipated. Neither did it look like, a lot of the people that I follow, what they thought it was going to look like. Having said that, we feel very strongly that our decision to increase diversification this year and for the foreseeable future will have a positive effect for the portfolios that we manage. When we look at the leading economic indicators from the Conference Board, the LEIs remain negative, and typically that has meant a recession. So the team and I would not be betting against the LEIs at this point, which is why, we believe that diversification among stocks, bonds, cash, and alternative investments is in your best interest. When we look at the portfolios, the S&P 500 and annual returns versus intra-year declines, again, this slide shows year to date through September. And at that point, we had slid about 8% to a 12% return for the year. Based on the numbers that we just talked about, the next time we see this, it'll show a 7% year-to-date return with a 13% intra-year decline. The big question that I know everybody's going to want to know is, where do we go from here? What do we expect from here? We're not quite sure whether we're going to see a Santa Claus rally or whether we'll see further declines between now and the end of 2023. And having said that, that goes right back to the theme of today is diversification. So let's talk about the S&P 500 valuations a little bit. And this was the slide that we added into at the end of 21, because what we saw was the forward valuations give us the best picture of where we believe the S&P 500 is going to be going. And the S&P 500 for, those of us in the States, that's the best, indicator of the overall health of the market. It's a broad index and covers not just tech or value. It covers a little bit of everything. When we look at this at the end of 2021, we can see we were paying over 22 times earnings to purchase the S&P 500 at that point. A pullback in 2022 brought us below the 25-year average, and then the rise this year and the subsequent pullback puts us at about 17.8% earnings. So as we sit right now, we're still above the 25-year average of 16.7 times earnings. So we can safely say that the S&P 500 is still expensive relative to the average, which leads us again to, why are we diversified? And the other reason why we're diversified is real simple. Bonds didn't pay 4, 5, 6% before. Now they're doing that. Cash didn't pay 5%. Now it's doing that. And so we have options that we didn't have previously. So we want to take advantage of that. So kind of thinking about where are we going and what does the market, have in store for us, I think it's important to understand that when we're still at 17, almost 18 times earnings, that's expensive compared to, think about 2008, 2009, when we pulled down to under 10 times earnings. What we're anticipating is a drawdown, just like we experienced between 1999 and 2009. The odds are that, the pendulum swung back up. We believe that over the long haul, this pendulum is going to swing back down. And it's during these downswings of the price to earnings valuation, the PE ratio, that we believe that diversification is really going to make up a big difference for the portfolios that we manage. So let's talk about, where does economic growth come from and why now is a good time for diversification? Well, we've talked about this before. over 68% of GDP, the economic growth, the composition of gross domestic product comes from consumption. That's consumers. And so it's really important then that we're looking at and following what's happening in the consumer world. Safe to say that if consumers drive the economic spending, then we should be watching them, right? So this slide here shows household debt, and this is where I want you to see right here. Household debt is rising, and auto and credit card debt delinquencies are beginning to rise. So think about that for just a second. Doesn't take a genius to figure it out. If delinquencies are rising, if debt is rising, that's safe to say that spending is either going to slow or is already starting to slow. On the other side of that, what about savings and borrowing? Revolving consumer credit outstanding has risen. Okay, it's not at the highest point. You go back to 2007, 2008, and 9, you got up to 9% of disposable income, but we're at 6. And then this slide right here, this portion I think is really important for us to look at. And what we're seeing here is excess savings peaked out right around the top of the market. And the savings has gone down. I believe what happened here is personal savings spiked to an all-time high. We had a bunch of money because you couldn't spend it in 2021 or 2020 during COVID. The aftermath of that, and people are now exhausting their spending. They don't have it available to spend. And so lower spending is going to equal lower impact, on the economy and rate in a positive manner. We want to watch consumer spending and savings. We believe that since that drives 68% of the GDP, that as spending and savings is impacted, that we're going to see that the economy gets impacted. The other nice part about that, though, is that if we look at bond and cash rates, and here's what I want you to see is the yields, the annual yields as of September of 23, the 2-year treasury at over 5%. We look at the 30-year is only at 4.73%. So again, there's that inversion and the inverted yield curve happening. We're going to talk more about that in a second. But then we start looking at investment grade corporate bonds. We start looking at high yield bonds. We start looking at mortgage-backed securities. You've got a lot over 5 and 6%. So cash and bonds are an alternative and should be part of everybody's portfolio. They didn't work in the past because you're only getting 0.0% in cash and maybe 1 or 1.5%, 2% in bonds, and that wasn't enough to stay in front of inflation. When we look at that yield curve, I thought it would be really neat to share what the yield curve looked like back in 21. So here's December of 2021. This is what a normal yield curve looks like. Okay. Now, granted, the 2-year treasury was paying 0.7%. The 30-year treasury was only paying 1.9%. So it wasn't a great option as a diversifier in a portfolio. But that's that yield curve, 0.7 is lower than 1.9. And that was nice, a nice typical yield curve. Well, here's where we are today. So as of September 30th, you can see this is a very inverted yield curve. At the top of the curve, we're paying 5.5%. But you get out to those 20 and 30-year numbers, you're paying 4.9 and 4.7%. What that means is that the market believes that interest rates in the future will actually be lower than where they are right now. And that's what that represents. And whenever we see short-term interest rates higher than long-term interest rates, it's typically something broken in the market space and in the economy. We don't know what that is. We haven't seen it. We haven't seen a recession, but we are definitely keeping our eyes on it. Back to diversification. This slide is showing it in purple, the times when international stocks, international equities, outperformed U.S. equities. The times in black are periods when the U.S. equities outperformed the international. It's been a really long ride of the U.S. outperforming international markets, and it was painful. A lot of times clients would even say, why don't we bring more to the U.S.? Well, because of exactly this. here we are for the last 1.9 years, where overall the international equities are outperforming US equities right now. So this is why we keep that diversification between US large cap and small cap and mid cap and international stocks and bonds, and we mix them all together depending on your risk tolerance to help you to get through from point A to point B. We talk about this many, many times, and this is just an updated slide of cash that's inside of money markets and 12-month CDs and other places. You can see that cash has gone to an all-time high. We've moved cash to the sidelines. It's paying. You know, you're able to get rates on cash at really, really decent rates, especially if you're using online savings account or, you know, high yield savings account. CDs are paying fairly decent depending on the term that you take on them. The problem is this, in our opinion, is that when people start to say, I don't want to stay in cash any longer, and it's time to move it out of the cash and try to get more of a yield on it, there's alternatives. There are bonds, and there are, you know, there are alternatives. It's not just going to go into cash, so that cash on the sideline today may not fuel the next jump in the stock market because of having options out there. And then when cash is paying 4 to 5%, for a lot of people, that's just a nice number to say that'll get me where I need to go in the short term. Cash, short term, fine. Long term, it's not going to outperform inflation. So make sure that you have a plan for your cash that's on the sideline. So where do we go from here? We always talk about this, that there's 3 choices at the end of the day. We're probably going to add, you know, we've added a 4th one. You've heard us talking about it a little bit, but, you know, we want to talk about your cash. That's your 1 to 3 year money. Your bonds is your 4 to 7 year money. And then 7+ is, you know, what goes into the stock market. When we're looking at cash, you know, obviously Social Security and pensions is part of that. You might have other guaranteed income. And then on top of that, it's your savings and checking accounts. Okay. Bonds, again, you know, treasuries, corporates, a little tiny bit of high yield. High yield bonds act a lot more like stocks. So we, you know, caution people, you know, just because it has the name bond and it doesn't necessarily mean it's going to act like a treasury, that's for sure. Or muni bonds would be another option. And then the stock markets, and then you've got the US and international market spaces out there. If you want to be a bit more conservative but didn't want to sit in cash, we'd recommend discussing adding non-correlated alternatives to your portfolio. So there's, you know, a 4th bucket, and we're big fans of utilizing a 4th bucket right now, somewhere between maybe 8% and 14% or 15% of your portfolio. We're not talking about big chunks. We're not talking about taking big swings here, but just something to add some more diversification to the portfolio. And then finally, we're not opposed to moving an additional percentage of your stock bucket to the cash bucket. Caveat being is that make sure you have a plan to move the cash back to the equity bucket. A lot of people, you know, right now what they've been doing is they have cash on the sidelines that they have been saving, and just based on, you know, volatility of the stock market, they have not put it into the market. So one of the ways that you could do that, and that we're big fans of, is what's called dollar cost averaging. It just is a nice, easy way to move cash into the market. And basically, here's what it says. Assume you had $120,000 of excess cash that you want to get back into the market, but we're nervous that if you put it all in right now, it's the wrong time. So you could divide that by either 6 months, you could divide it by 12 months, you could do it by other numbers as well, but those are typically really good numbers. And so think about that, $120,000 divided by 6, you've got $20,000 to work with. And you would just take it and say, I'm over every 6 months or every month for the next 6 months, we're going to put $20,000 back into the market. And if it was over 12, you would just do $10,000 back into the market. What's best for you? Speak with your wealth advisor, come up with a plan, and then stick with it. We hope that this helps, and we are happy to share. If you want to reach out to us, if you have questions, feel free to call me at 350-7273. And for more information, you can always check out our website, feel free to share this with somebody else as well. Have a great day, everybody. Take care.